500 to 1. Pause on that number. Not as market trivia, not as a dramatic exaggeration, but as a structural fact. Right now, 500 paper claims exist for every single ounce of physical silver that can actually be delivered. 1 ounce. 500 promises. That ratio is not sustainable, and this morning, the system built on it is beginning to fracture. This is not fear-mongering. This is mechanics. A market can tolerate leverage only as long as nobody asks for reality. As long as contracts are rolled, cash is accepted, and delivery remains theoretical. The moment real demand enters the equation, leverage stops being a feature and becomes a fault line. Recently, silver pushed into uncharted territory. The response from the paper market was predictable. Margins were raised aggressively. Leverage traders were flushed out. Prices were forced to lower on screens. On the surface, it looked like order had been restored. But beneath that surface, something far more dangerous occurred. Physical silver refused to comply. Instead of falling, physical premiums expanded. Buyers paid more to secure real metal, not less. Delivery timelines stretched. Secondary markets heated up. Across global trading hubs, the price of reality diverged from the price of promises. And that divergence is the earliest signal of systemic failure. Markets do not collapse all at once. They split first. Paper detaches from physical. Confidence erodes quietly. Participants stop trusting settlement and start demanding fulfillment. The silver market has functioned for decades because almost no one ever asked for delivery. That condition is changing. The moment even a small percentage of paper holders demand metal, the math turns brutal. 500 claims cannot become 500 deliveries. There is no workaround for that. There is only repricing. Everything that follows in this analysis flows from that single imbalance. And the price outcome it implies is far beyond what most investors believe is possible. Stay focused. What comes next is not opinion. It is arithmetic. If this analysis adds value, subscribe to the channel and leave a comment. To understand why this imbalance matters, you have to separate price from value and paper from possession. The number flashing on a screen is not the silver market. It is a derivative of confidence. It exists only as long as participants believe delivery is possible, even if they never intend to ask for it. The paper-silver market grew massive because it solved a convenience problem. Traders could speculate without storage. Institutions could gain exposure without logistics. Banks could intermediate without holding full inventory. Leverage made everything efficient, liquid, and profitable. As long as demand stayed abstract, the system worked. But abstraction breaks the moment silver becomes strategic instead of speculative. When industrial buyers need metal to keep factories running, cash settlement stops being an option. Dollars cannot replace atoms. Batteries, solar panels, and electronics do not care about spot prices. They care about supply. What we are witnessing now is the collision between financial design and physical necessity. On one side sits a derivative structure optimized for trading volume and leverage. On the other sits a finite pool of metal that must be mined, refined, shipped, and stored. Those two systems can coexist only while demand for delivery remains minimal. That assumption is no longer safe. Inventory buffers have thinned. Strategic buyers have moved early and quietly. Refining and export bottlenecks have tightened supply chains. Banks that once promised seamless delivery are now asking for patience. When a market begins asking for time, it is already short. This is where leverage becomes lethal. A 500 to 1 ratio does not mean prices are 500 times too high or too low. It means there is no margin for error. A single surge in delivery demand can overwhelm the entire structure. Most investors believe markets fail because of panic. In reality, they fail because of arithmetic. When claims exceed supply by orders of magnitude, the only variable left is price. And price does not adjust politely. It moves violently. Now we move from structure to numbers, from theory to calculation. Because once you quantify the imbalance, the outcome becomes unavoidable. Let's put hard numbers on the structure because once you quantify the claims, the illusion disappears. The silver market is not opaque. The data is public. It is filed, reported, audited, and largely ignored because the implications are uncomfortable. Start with futures. Across active delivery months, hundreds of thousands of contracts exist at any given time. Each contract represents a fixed quantity of silver that in theory can be delivered. When you multiply open interest by contract size, you arrive at a notional amount that already dwarfs what exchanges actually hold. This alone would be manageable if futures were the only layer. They are not. On top of futures sits a vastly larger over-the-counter market. Swaps, forwards, and unallocated accounts form a shadow structure where silver is promised multiple times over. These instruments are not designed for delivery. They are designed for liquidity and balance sheet efficiency. Metal is reused, rehypothecated, and referenced, not segregated. Now compare that paper volume to what can actually be delivered. Not total vault holdings, not reported inventory, only metal that is registered, allocated, and free of competing claims. When you strip everything else away, the number is shockingly small. That is the fulcrum of this entire market. Divide total paper claims by deliverable metal and the leverage ratio explodes, not 10 to 1, not 50, hundreds to 1. And this calculation assumes cooperation. It assumes calm. It assumes most holders remain content with paper exposure. But markets do not need everyone to demand delivery. They need only a minority. 10% is enough. Even 5% begins to strain settlement mechanisms. At those levels, exchanges face a choice they cannot escape: find metal that does not exist or settle with cash at prices disconnected from reality. This is why leverage-driven markets appear stable right up until the moment they are out. There is no gradual unwind when claims exceed supply by orders of magnitude. There is only a repricing event. And once price is forced to reconcile paper with physical, the move is not incremental. It is discontinuous. Next, we examine what happens when delivery demand rises just enough to expose the shortage, and why the resulting price is not speculative but mathematical. The critical mistake most investors make is assuming delivery demand has to be widespread to matter. It does not. In highly leveraged markets, pressure builds exponentially. A small shift in behavior can trigger an outsized response because the system has no slack. Imagine just a fraction of paper holders deciding they no longer want exposure, they want possession. They submit delivery notices, they stop rolling contracts, they reject cash settlement. On paper, this should be manageable. In reality, it is catastrophic because the metal simply is not there. Exchanges respond in predictable ways. First, they raise margins. This is designed to flush out speculative longs and reduce open interest. It works on traders, but it does nothing to create silver. Next, they stretch timelines. Delivery becomes delayed, then extended, then under review. Language changes before policy does. Banks follow a similar script. Unallocated account holders are told to wait. Weeks become months. Requests that once cleared in days now require approvals. These are not administrative issues. They are inventory problems. As pressure builds, a fork appears in the market. The quoted price continues to trade in derivatives venues while real metal trades elsewhere at a premium. This is the moment of separation. The paper price becomes a reference, not a reality. Physical silver begins to price itself independently, transaction by transaction. This is not unprecedented. It has happened in energy markets, in base metals, and in currency pegs. The pattern is always the same. When a promise can no longer be honored universally, the market segments. Those holding claims stay behind. Those holding assets move forward. At this stage, the price signal becomes unreliable. A lower paper price does not indicate less demand. It indicates forced liquidation. Meanwhile, higher physical premiums reveal the truth. Scarcity is intensifying, not easing. The market is no longer clearing. It is rationing. From here, price stops being about valuation and starts being about access. And that transition changes everything. Next, we examine why industrial buyers are the accelerant in this process, and why they cannot simply step aside. Industrial buyers are the point where theory ends and necessity begins. Speculators can exit. Funds can rebalance. Traders can accept cash and move on. Manufacturers cannot. when production depends on silver, delivery is not optional. Modern economies are more silver-intensive than most people realize. Energy systems, transportation, electronics, and data infrastructure all rely on it. These industries operate on schedules, contracts, and commitments made months or years in advance. They do not have the luxury of waiting for markets to normalize. When supply tightens, industrial buyers do not negotiate with futures exchanges. They go directly to the source. They call refiners. They call miners. They offer premiums. If the quoted price does not secure metal, they raise the offer. This is not speculation. It is continuity planning. This is where the paper market loses relevance. A manufacturer does not care if a screen shows a lower price if no metal is available at that price. Cash cannot replace input materials. Production lines do not run on settlement statements. As more industrial demand bypasses derivatives, venues available inventory shrinks further. This creates a feedback loop. Less metal on the open market means higher urgency for remaining buyers. Higher urgency drives higher prices. Higher prices expose more paper holders to loss, prompting further attempts to convert claims into metal. At a certain point, price stops being the constraint. Time becomes the constraint. Buyers pay not just for silver, but for speed. Immediate delivery commands a premium far above any quoted benchmark. This is how markets break without crashing. The structure remains, but it no longer performs its intended function. Price discovery fails. Allocation replaces valuation. And once allocation takes over, there is only one mechanism left to restore balance: repricing to a level that forces demand to retreat or supply to expand. In the next chapter, we quantify that price and show why it is not extreme but inevitable given the imbalance. This is the point where analysis stops feeling comfortable. Not because it becomes speculative, but because the numbers force a conclusion most people resist. The price required to rebalance this market is far higher than intuition allows. Not because silver is suddenly scarce, but because deliverable silver is. Price is not set by averages or forecasts. It is set at the margin where the last willing seller meets the most desperate buyer. In a market where physical supply is counted in tens of millions of ounces and potential demand is counted in billions, that marginal price does not move gently. It resets. The right question is not what silver should be worth. The right question is, at what price does behavior finally change? At low prices, nothing changes. Industrial buyers pay up and continue production. Silver remains a small fraction of total product cost. Margins tighten, but operations continue. Even at significantly higher prices, demand does not collapse. Manufacturers absorb the increase because stopping production is more expensive than paying more for inputs. Silver must become a meaningful share of finished product costs before demand begins to break. That threshold is far higher than most investors assume. At the same time, supply does not respond early. Physical holders do not sell into the first rally. History is consistent on this point. In every major commodity squeeze, meaningful supply only appears after prices move several multiples beyond prior highs. Holders wait for confirmation, for panic, for exhaustion. That delay matters. It creates a narrow window where demand remains strong and supply remains withheld. Price rises rapidly through that window until both sides finally react. That level is the clearing price. It is not negotiated. It is discovered under stress. And once it is reached, the market does not revert. The leverage that suppressed price is gone. The structure has changed. Next, we move from theory to timing because this process is no longer hypothetical. It is already in motion. Timing is the difference between understanding risk and being trapped by it. Structural imbalances can persist quietly for years, but once pressure reaches a critical point, events accelerate. What appears gradual in reports unfolds rapidly in markets. Silver is entering that compression phase. The first signals are subtle but clear. Delivery requests rise as available inventories shrink. Processes that once cleared automatically now require review. Institutions begin using cautious language referencing delays and constraints. Those words surface only when certainty is already eroding. As stress builds, exchanges respond predictably. Margins are raised, forcing weaker participants out. Position limits tighten. Cash incentives are offered to discourage delivery. These actions do not fix shortages. They only slow exposure by reducing participation. Serious buyers adapt quickly. They move off exchange. Direct negotiations replace open markets. Transparency fades as pricing becomes situational rather than quoted. The market fragments with different regions trading at different levels based on access and urgency. Fragmentation accelerates the breakdown. Once participants realize there is no single clearing price, trust dissolves. Rational actors rush to secure metal while it is still obtainable. This is not panic. It is logic under scarcity. Eventually, the formal market acknowledges reality. Physical delivery is postponed, restricted, or replaced with cash settlement. That moment ends price discovery. Prices do not adjust gently, they reset. The transition is fast and unforgiving. Those positioned correctly endure it. Those who are not do not get a second chance. Next, we examine how this shift impacts investors and why possession becomes the dividing line. This is where the divide becomes permanent, not between optimism and fear, but between claims and control. When markets run smoothly, that difference feels theoretical. When they fracture, it becomes decisive. Paper instruments function on trust. Trust that custodians hold what they promise. Trust that settlement will occur on demand. Trust that redemption is real, not conditional. Delivery. Stress tests that trust, and it rarely survives intact. As pressure builds, paper holders all attempt the same move. They try to convert exposure into possession. ETFs face redemption waves. Unallocated accounts request allocation. Futures traders stand for delivery instead of rolling. Each action is rational. Together, they overwhelm the system. The outcome is uneven fulfillment. Some requests clear. Others are delayed. Many are settled in cash. Once cash settlement becomes common, confidence collapses. Instruments once treated as equivalent are revealed to be fundamentally different. Price signals lose meaning. A quoted number no longer reflects access. Discounts emerge. Premiums explode. Two investors who believe they own the same asset realize one owns metal and the other owns a promise. Markets resolve this imbalance predictably. Capital moves toward certainty. Investors accept higher prices to eliminate counterparty risk. That migration does not reverse. Those waiting for reassurance discover clarity arrives too late. Liquidity disappears precisely when it is needed. What remains is a physical market pricing itself independently. Once that shift occurs, the old structure does not return. Next, we look at how stability finally emerges and why prices never fall back to prior levels. After the break comes disorder, and after disorder comes resolution. Markets cannot remain fractured forever. They either collapse completely or rebuild around a new foundation. In silver, the foundation becomes physical reality. Once paper credibility is lost, price no longer flows from benchmarks. It forms transaction by transaction. Buyers negotiate directly with sellers. Location logistics, purity, and timing matter more than reference quotes. The market becomes inefficient but honest. During this phase, volatility is extreme. Prices gap higher not because of speculation, but because offers vanish. Sellers wait. Buyers compete. Metal moves only when the price compensates for scarcity and risk. This is how the clearing level is discovered. At the same time, behavior begins to change. Industrial users redesign processes to reduce silver intensity. Substitution becomes economically viable. Recycling accelerates. High prices pull supply forward that was previously uneconomic to recover or produce. Physical holders respond more slowly. Many waited years for this moment. They do not sell into the first surge. They sell only after prices move far beyond prior highs and fear replaces disbelief. That delay matters. It keeps supply tight even as prices rise. Eventually, these forces converge. Demand weakens at the margin. Supply appears incrementally. Transactions increase. Volatility subsides. The market clears, but the price does not return to where it started. The leverage that once suppressed it is gone. The old equilibrium depended on claims vastly exceeding metal. That condition no longer exists. The result is a new baseline, not a spike. A price level where silver is rationed, not abundant, where access, not exposure, defines value. In the final chapter, we draw the strategic lessons, the risks, and the actions that matter before this transition is complete. This is where analysis becomes action. When a leveraged system resets, it does not reward perfect timing. It rewards correct positioning. The silver market that existed under extreme leverage is gone. It is not coming back. The core lesson is simple. Paper exposure functions only while trust holds. When trust fractures, ownership matters more than price. The investors who